All right, we got a long lower shadow alert today. Very bullish typically. Does that mean now that this is the end of the declines? Are we ready to go full bore, especially with investor sentiment being as bullish as it was heading into a weekend, which is not typical, as considering that previous weekends we've gotten the bad news. So does that mean now we're ready to go? So I'm going to break down this pullback in context of what our expectations have been for an intermediate pullback, how they've been met or not, and what to expect now next week and the week after going forward from here, with a trade idea on the stock that has really been doing poorly and appears to be breaking down itself, and how to trade that one. So let's go ahead and get started. Today is Friday, May the 10th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, as always, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see a second day of a long lower shadows here, even bigger today, a little bit of a hammer pattern you can call today on the S&P 500. The intermediate line did fall, continue to fall, and now it's down below. You can see the short-term sentiment lines are always kind of below it. Now it's falling below the short-term sentiment lines. So we'll keep our eyes on that. That's obviously not the most bullish pattern when the intermediate line's below the short-term sentiment lines. It's a lot more bullish when the intermediate line crosses and it gets up above. So we'll see, how long that stays to be the case. Of course, you can get intermediate pullbacks like we did right here. Even here, the intermediate line cross a little bit below short-term sentiment before turning back higher and then getting up above. So that's the most likely pattern. You can see this is the more bearish pattern when the short-term lines are up above the green line. As of right now, we expected a intermediate pullback. We didn't expect this intermediate pullback because no one did, right? But we did expect a intermediate pullback, and we did expect that there would eventually be something down towards this 2807 level. That's where the Fibonacci line has been here for a while. We've talked about the multiple touches in this area. We've also talked about the volume support, as you'll see here. We'll take a look here on the Bollinger Band charts. Again, if you look at the volume for the futures contracts, right around that big volume node at 2800. And then, of course, when you look at the ETF for the S&P 500, also 280, having that big volume node right there. Excuse me. So a lot of technical support, a lot of volume support. Of course, it's a big round number, 2800. Fibonacci support. So, but until then, we're getting some lower ranges. And just because we rallied today, and just because we closed above yesterday's high yet today, doesn't mean I don't think necessarily that this intermediate pullback is over. I mean, ideally, we don't want it to be over, right? Because then we'd really have a divergence. If it turned up right now, and we had a lower low on the intermediate line combined with a higher low here on the index, that would, again, just be another case, a divergence, similar to what this one is, and similar to what we saw over here, that would lead to weakness. And it also would continue this 4-month intermediate run that we've had now since January the 11th when we crossed above 50. Now it's almost May the 11th. It will be obviously tomorrow. So we've been on a run now for 4 months. This strong intermediate run, not necessarily the most, we wouldn't necessarily expect another 3-month rally to come out of this. If we turn back up today without the intermediate line falling below 50. Falling below 50 is a different story. Right? We can get it below 50 and turn back up, great, and 1 to 3 month rally. So that's why I still think that there is actually some more run left within today's range. Probably not as quickly as what we've seen, but probably, like we saw over here, some ups and downs within this range, and potentially even coming down closer towards 2800. I mentioned before, that, when we were up here at 29 plus, that we talked about, a 23% Fibonacci retracement would be over a 100-point move to the downside. And how uncomfortable that would be for a lot of people, even though it would just be, the shortest of Fibonacci retracements. And the reality is, we've seen how uncomfortable it is. It shouldn't be this uncomfortable, and that means that we rallied too much. That means we have a lot of weak hands right now. If we're viewing this as a big bearish move to the downside, then that means that we probably got in here on a lot of bullish trades instead of over here and gradually more as things rally. So that's the problem, right? And again, to get a good extended move to the upside from a sentiment standpoint, we need some more of those weak hands to come out, so we can get some stronger hands building positions that will last a little bit longer than just a week or even that long, if depending upon how long this next little near-term rally that we're on here. You see the near-term line, like I mentioned before, formed in the last video, formed a bullish divergence here with the higher lows combined with the lower lows. The near-term line did not get below 20, just like it didn't get below 80 up here, and that's a bearish sign. It didn't get below 20, so that's actually a bullish sign. We're back up, and we only stayed down for a few days, which is also a bullish sign. It was a lower near-term low, so not so bullish there. And now the question is, just like last Friday, where is this near-term line going to peak? Is it going to peak above 80, which is what you need to be bullish? Is it going to stay above 50 for 7 to 12 days? Or 5 to 7 days now that we're so mature in this trend, but closer to the 7, right? To the 7-day mark is the ideal scenario. It didn't do that here last Friday when we talked about those two things to watch for the upcoming week. It didn't happen there, and now we're in the same scenario, right? We got another bounce. We're in the same scenario of where's that next peak going to occur? Because remember, the previous peak, when you look at the index itself, is right here. So we have to get above that high to avoid a second consecutive lower near-term high coming off of a lower near-term low point. Obviously, that's the definition of a bearish trend. Of course, it's a short-term trend, but that's our intermediate pullback. That's what intermediate pullbacks look like. And as long as we hold this level where that last 1% drop got to here, then that's fine. That's what happened on the last intermediate pullback that didn't cause a 10% plus drawdown. This last pullback got to the previous 1% decline, and we bounced off of that. And just like this is kind of what we'd expect to see going forward. So, has this been enough of a pullback? I don't think so, and I don't think that we're done with it yet. I still think we have some more to trade around up and down here in this area between 2,800 and basically today's open as we pull, eventually potentially pull back down into this zone. And again, not that will be up and down, we saw up and down the last 2 days, but from a day-to-day perspective, we'll most likely start to see some weakness and strength and bouncing and up and down. And bring that intermediate line below, set up a better base, and then we look for the bounce off of it like we got over here on 7.6 where we closed above the moving average, and then on 7.9 where the intermediate line crossed up above 50, and the way we went from there. Let's take a quick look at the other indexes here. You can see the Dow Jones Industrial Average, a little bit of an engulfing pattern to go with the long lower shadows in yesterday's hammer. Its intermediate line did cross below 50, but it had crossed below 50 over here too. So the Dow Jones has been giving us more of these intermediate pullbacks that we haven't seen yet. Even dark pink, that's the dark pink shading that you see here. You kind of need that to get an intermediate pullback. It doesn't need to be too extensive. That's when you get, and with the red lines, that's when you get bearish, right? But we need, this is an intermediate pullback here. It got a little bit below 20, more than the S&P did, but that's what it looks like. That's more of an intermediate pullback than even what we saw over here. You look at the NASDAQ composite, which has been such a big winner. It's still got some room to move to the downside. And of course, the Russell 2000, which lately has been the biggest winner, it's showing a pink shading here and a yellow line as we flirt with the moving average. Remember, it also got the intermediate pullback that we never did on the S&P or the NASDAQ because of the strength in the FANG stocks that wasn't so strong in other areas of the market. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your video, then hit that red subscribe button that pops out. Also, click the thumbs up icon down below the video. That tells us that you got something out of the video today, and it tells us that you want us to do the video again Monday. So if that's the case, hit that thumbs up icon down there. Also, comment on the video on anything that did stand out to you. What did you get out of the video? What do you think other people should watch the video for? Go ahead and comment down below. Join our daily market outlook email list. Remember, it's a Friday email today. You get the watch list that come along with it. The weekly clusters and the daily clusters. Make sure you scroll to the bottom of the email to get that. There's that link popping out up there. Very easy way to subscribe. Follow me on Twitter for more content like this in between the videos from day to day to keep that conversation going. And also join our community that we created on Facebook. Also, if you're watching our posts, our video here on our blog, remember here, there's a lot of different things on this page, including a link to our Market Outlook forums, a link to subscribe to our site for free up here in the top right corner, the upcoming calendar of classes where you can see the rest of them there with this View More link. And then down below, down here, I mentioned before, if we can get this number up to 100, and I figured out what made it static last week. If we can get this number up to 100, then I'll post another blog post for our site subscribers here with an update on recent Market Outlook trades I've been doing. So again, you can share this blog post in any of these formats, and then as that number gets above 100 over the weekend, then I'll post that on the website. All right, back to the charts. We take a look at the weekly candles here. You can see a big bearish candle here this week, not surprising, with a long lower shadow as well as a little bit of an upper shadow filling in the range, the upper shadow filling in the range of last week's lower shadow. From a Haken-Yashi standpoint, you can see relatively big sized transition candles. You can see instead of a small range, I mean this one was a little bit of a bigger range too. Back that week of January the 29th of 2018, another relatively big size candle here, and of course that size actually stayed in with the big ranges that we were coming up out of in January. That was so big relative to the ranges before that. Here the ranges have been relatively big. We had some transitions, we continued higher, and now we're here. So again, are we going to get another week or two of bearish candles coming out of this? Most likely. So that's why another reason why I say I don't think necessarily that this intermediate pullback is necessarily done. It would have been a lot more healthy and fine had we had that over here. But considering that we're 17 weeks up and we had moved up so much in 4 months into this rally, this might not be the same type of intermediate pullback that we saw over here when we weren't coming up off of 17 weeks of bullishness. We weren't so far up above the 200-day moving average. And you can actually see over here at this point in time, the MACD down here, which this is the percent price oscillator, which compares the MACD on a percentage basis, relative basis, rather than absolute basis. We're actually a little bit higher now than we were then, but we were coming up off a much low point. You can see that big move higher during that 7 weeks, much bigger run than even this one was, when all was said and done, including the intermediate pullback in the middle. Let's take a look now at the daily chart, and you can see on the three, we got 3 red arrows still. We are still below a rising moving average, so we don't have the red line there. So that's not that bearish combination quite yet. And then when you take a look at the 3, here, let's get rid of these lines here. When you take a look at the 3, these are lines that we looked at today in my technical analysis class. When you see that the MACD is now below 0, similar to over here, but not significantly below 0, and the same thing here, the stochastics is below 50. It's not in oversold territory, and this one got a little bit closer to oversold territory, so I wouldn't be surprised if this did here. But again, remember, this is the last intermediate pullback that we got that didn't produce a significant drop, a correction type move. Again, the type of move that we're expecting here. So we're probably going to get some more trading in this area here. And of course, remember, all the support that's around this 2800 will limit the downside moves. But that won't necessarily mean that we're going to bounce up immediately either. So that's kind of what we're looking at there. And let's take a look at the intraday chart. And you can see that, look at the wild move we had today, outside day, because we did get a lower low point. We didn't gap down there. But we did get a lower low point and set a new 4-week low, which is now a 12-point gap, not quite that 5% to the downside. Remember, it's a 10% move to the downside that kind of stretches the rubber band out. We're moving down, but we did get a new 4-week low point, a lower low. But then we rallied all the way through yesterday's relatively big range and finished with we finished up above yesterday's high point. Pulled back, return move at the very end of the day before bouncing and closing up above yesterday's high. So a higher high, lower low, but then a higher high and closing. Much better than we did at the open. Remember, it's the close that matters more than the open. And especially going into a weekend because you have 2 days off instead of just an overnight trading session. So really good, strong close. Again, I don't necessarily think that we're going to be rallying up. Now you can see we're still in the lower half of the 4-week range. We got right up to it, but stayed down below it. The Hakenyashi Open is going to move a little bit to the downside as well. In fact, we can figure that out here. Remember, let's go to SPY and then the Hakenyashi Open. Let's see. Let me get my calculator over here. All right, so you can see the Open is at 291.34, and then this week's close is 288.24. Divide that by 2 and add that to 288.24, and you see 289.79 is where this line is going to move now. So 289.79, and we'll hit OK. And there we go. There's where next week's Hakenyashi Open will be. So unless we get above 290, we'll have a bearish candle, right? Depending upon where we close and how we trade. So depending upon where we open next week and where it trades, and you can see there's going to be some intraday resistance between that Hakenyashi Open and the full week midpoint, which isn't going to change for a while because both the high and the low tag got a long ways to go to get off this chart over here to the left. So that midpoint is going to be there for a while unless we produce new lows and highs. So there's going to be some, at least at the beginning of next week, that's going to be some intraday resistance in this area. Again, weak because it's so short term, but a resistance nonetheless. Let's take a look now at the today's volume and trading range on SPY, and you can see the trading range way up above the average, up to 6.64 points, filling in any gaps we may have had. The volume, really high volume. In fact, if you look at the week, you can see after just a 5.5 point range last week, we end up with 11. So we double the range, and then look at the volume down there, getting up to 1.5 times the average volume for a week, which we haven't had this much volume since these pullbacks back in this area. So you can see again, there's that last intermediate pullback we never did get. We had a little bit of volume there at the end of the pullback in 2018. Again, that's the kind of pullback that did not produce this correction. You got a few more over in this area. Some of them producing some volume more than others. So this just because we got a big spike in volume here doesn't necessarily mean that we're tanking to the downside like we did here or here. But it's a pretty decent amount of volume, and if you look at in context, the 112 million shares is right about in this area right there. That's a bearish territory because it's not too extreme. Now the trading range was an extreme, that over 7 or almost 7 points. That's pretty much the peak for the 52-week range for the ATR. So that's a pretty high day. If we continue to get those kinds of days, then we are going to get this kind of move to the downside. Otherwise, you can see, you'll get, these kind of days that peak these up a little bit, but then as you saw over here, will flatten out. The trading ranges will start flattening out and then moving back lower as we bounce, and that's more of what I expect rather than continue to the downside. Of course, headlines can throw all that out the window, but as we end the week with what could be the worst headlines possible, the possible outcome of this week, and the market's rallying, is a good sign that we might not get the type of headlines that will produce this kind of drop, or even this kind of drop that we had post FOMC last December. Let's take a look at the volatility index, and that's the other reason why I don't think we're going to be spiking anytime soon. because you can see while we did get up above 105% this week, look at that dramatic drop all the way back into the neutral zone. That's a pretty steep drop in a short amount of time on volatility to go from 23.38 down to 16. 30 plus percent, almost about a 30% drop in volatility in 2 days, because this was yesterday's open here that got us up to that high point right at the open. That's a big time move to the downside. So, again, if the market was too concerned heading into the weekend, we wouldn't have had that kind of a drop. But now, again, 15 is going to act as a support as we pull back down here. So that's why I say we can still muddle around in this area and still muddle around in this area between 90 and even up to 1 before we bounce into a new bullish trend. We break the 90% mark and then establish the new intermediate run at that point. All right, before we dive into what's driving the market action, price action from an intermarket standpoint, as well as today's trade idea, and now I want to hear from you in terms of what you think about this outlook. Do you agree or disagree with it? Click that link that's popping out up there in the top right corner of your screen, and then as it opens up, hit either agree or disagree. If you click disagree, scroll to the comment section down below and let me know, what do you think that either makes you more bullish or that makes you more bearish than what we've come up with through our market outlook routine. All right, let's talk about now how these different asset classes are performing. Of course, this is a trade, right? The main thing that's driving price action and investor sentiment right now is trade deal headlines, essentially, from one end to the other. And you can see that's having an impact on the S&P over the last, week or so, pretty much all this week. In fact, let's zoom into just this week here in May the 6th, and you can see, obviously we started off poorly to begin, to begin the week. Crude oil had a little bit of a bounce to some pretty strong levels, and then actually crude oil finished the week pretty flat, which is not a bad thing considering that that's usually your highest beta asset class, and the fact that everything else was so negative for the week despite the bounce, that crude oil finished flat. Not surprising to see long-term bonds having an up week, gold having an up week. The dollar is flat, relatively speaking. High-yield bonds were down along with stocks. That's not surprising either. You also see that the agricultural commodities are all down too, with the biggest declines of the week, along with international stocks. Of course, emerging market stocks down by far the most, like doubling the losses of what you see in the S&P and developed market stocks. So, big decline in those areas. Now, they did pick up, off 7% from 7% declines that we had earlier this week. But, of course, they are obviously more impacted earlier in the week from the headlines, even if today they weren't as impacted. If you just take a look at just today alone, you can see that emerging markets actually fell less than U.S. stocks did early today, and you can see it was a broad-based sell-off early on U.S. stocks, small cap stocks, and large cap stocks. But then by the end of the day, the S&P 500 pretty much made up that gap with emerging markets and rallied to almost similar gains to what you see in emerging markets. Of course, developed markets ended up with the best gains of the day, interestingly enough. And of course, agricultural commodities, which is a little bit of a reflection of what's going on with the trade deal from an investor sentiment standpoint. Agricultural commodities continue to be just beaten up, and you can see going down to new 5-year lows. And if you just take a look at the market forecast for the ETF, and you can see clusters again today, clusters for the week. If you take a look at the week, we got a cluster again this week. And you look at the monthly chart, we've had clusters for 7 out of the past 11 months. So it's a significant downward turn. In fact, just looking at like quarter after quarter, we've had 4 quarters in a row of clusters. Of course, it's so and this actually only has the 3 lines, but you get the idea here that again the the weakness that we're seeing in the negative expectations revolving around the trade deals really being impacted more here than anywhere else. Also interesting relationship too in terms of the bullishness in the stock market is it's not that same bullishness is not coming through in the bond market. Bonds still continuing to rise along with stocks. That correlation here between the two, if you take a look at the correlation with the S&P 500 and look at the last correlation over the past 3 months and hit OK on this, you can see it's a negative correlation between yields and the S&P, which, on a weekly chart, mind you. Now, if I were to change this to a daily chart, here we go, on the daily chart, you can see it's a pretty negative correlation, on the 63-day chart, which would be a 3-month chart. It's pretty rare for us to get as steep a negative correlation, and it's also not too often we stay this long. So in other words, when we rise, it rises pretty quickly. The correlation gets back to strongly positive very quickly, and the question is going to be which one's going to bounce back. Are they both going to jump up pretty good? Are they because there's always a pretty decent move in the markets, one way or the other when you get these moves back to strong positive correlations. So which one's going to move? Is it going to be the bond market that continues to move to the downside with more of a deeper pullback, or are we going to get a bounce up here in yields that coincides with a more of a rally into the end of the year with stocks? So it's kind of interesting development. But as of right now, the bond market's saying that we shouldn't be, because that's the one that's down while the stock market's been up. The bond market's saying that, especially for this year, this is 2019 here, bond market's saying that we're not nearly as bullish as what the stock market is suggesting. Interestingly enough, when you look at a lot of these ETFs over, again, the past 3 months, you can see India has been a good performer from the beginning of this 3-month period, and Germany's done pretty well too here towards the end, and the S&P is right there along with it. Now, on the other end of the spectrum, you can see South Africa, Brazil is a big loser, but look at China. China, over this past 3 months, out of this list up here, some of the major economies out there, China's the worst performer. Outside of Brazil is the worst performer over this 3-month period. It actually was doing well and matching the S&P, in fact beating the S&P for a good chunk since the beginning of this time frame from what would this be, back in February. Stocks were up, China was up until about this point right here on April the 18th. The S&P continued higher in a little bit of a pullback, but China started its decline and now is down at this level, whereas the S&P. So you can see where the recent divergence is, and that goes with a lot of these. Mexico's there, Russia's there too. So it goes along with a lot of these emerging markets and their weakness. So we've had a couple of weeks now some strong weakness in emerging markets. Again, they're the ones that appear to be more impacted by these trade headlines than, as of right now, the more developed markets are, including the United States. And you see that, of course, also reflected in the 12 grid of the biggest economies out there. The S&P 500 is just a smidge, below its 30-day moving average, whereas, some of these developed markets, even Japan, with a nice little bounce today, but a lot of these others are way below falling moving averages with strong bearish postures, not like the S&P, which is still up above 50. Now let's take a look at the sector rotation and how they're performing, and we'll pull up the list over here on the right, and you can see utilities, the best performer today, along with materials and staples. On the other end, healthcare and discretionary are the biggest laggards, and really those are the only three that lagged behind the S&P. The rest of them really strong gains. You can see energy and technology over the past few weeks. Here, let's just zoom in on just this week again, and during this pullback that we've had, this 2% decline we've had in the S&P here this week, you can see that energy is actually holding up well, along with utilities, real estate, and staples. Right, that's not surprising. Energy Remember, crude oil has held up too this week, so that's helped that sector really do well. On the other end of the spectrum during the pullback, and really, if we were to start, let's go back to where the pullback, where we got the all-time high. So we really started on May 1st, at the open of May 1st. So let's go back to our sector comparison chart, and then go back to the beginning of May 1st. So that would be May 1st right there, and we'll go to a 10-minute chart again. So you can see during the pullback, materials has been a big decliner. Energy had been a big decliner more early than late. In fact, those two were your biggest losers during the initial phase. But now you can see technology is down there. You can see industrials also lagging behind the market during a run. During part of this run, financials lagged a little bit behind the market. On the other end of the spectrum, not surprising to see your safe havens. Again, they hold up well. And again, if we continue to have weakness, right, if this intermediate pullback's not done and we continue to hammer around this area and a little bit lower, because remember, it's about a 5% drop from towards that 2,800 level on the S&P. So there's still a little bit more to go here, and I would expect more cyclical areas to continue to lead to the downside. I wouldn't expect that much more weakness from materials and energy, because that dollar breakout that we had a couple weeks ago did not hold, right? And we ended up being back down, closing this week below 97.5, which is where the resistance was. So, I mean, now granted, this is a smidgen, so I wouldn't say necessarily that it's by definition a fake out, but it's not looking good, and it's leaning more towards being a fake out rather than a breakout, which, like I said before, tends to be more bearish than just holding resistance is. So a really good chance, if this fake out does hold, that we pull all the way back down here towards the bottom end of this retracement zone, towards this 94. And of course, a breakout above 98 or below 94 gets us going, out of this sideways muck that we've been in on the dollar. All right, now let's take a look at a trade idea for today. And one of the stocks I wanted to take a look at is Gap. Gap is actually a company that I frequented a lot more often when I was in high school than as an adult, and especially with kids. And again, I've always been of the type that, you invest in what you use a lot. And, if you're looking for long-term investments and ownership, might as well own what you like, right? What you like to use as a consumer, or any companies that might be involved in the process of what you use, whether it's networking or whatever the case may be. So like I said, Gap, I frequented a lot when I was in high school, not so much as an adult. And the stock is definitely not one I would want to even buy from a technical standpoint. In fact, you can see we're getting the bearish combination of a drop below intermediate line, dark pink shading, intermediate line below 50, strong bearish posture below a falling moving average. You can see from a three green arrow chart here. You can see that we have 3 red arrows with that drop in the moving average. You look at the Bollinger Bands for Gap, and you can see we're pushing down below the lower Bollinger Band. We're pushing down below significant support here. We're breaking down the past week below significant support, and now we have very little support in the last year from a volume standpoint. It makes it a lot easier to fall than it does to go up. And then you take a look at the DMI for GPS, and you can see we're above 25 on the negative, we're below 20 on the and the ADX, which was so negative because we were so flat, albeit at this high level, is starting to rise. And once it gets above 20, you expect a pretty decent trend. And of course, if I'm going to guess on a trend right now for this company, at least, I would guess towards the downside. I didn't show the 3 green arrow chart on the 2-line version. You can see that 8 and 17 this week crossing below the 30. MACD is getting down to low levels. Stochastics is to low levels. And then finally, from a long-term standpoint, this stock is on a bear market. Extended death cross here. We jumped above the 200-day moving average on earning, got right back down below the next week, and now appears to be breaking down below these lows. And pushing down towards other lows from the past 5 years. So there's a good chance that we can do a bearish trade on this. If we take a look at his options at 42 days out, we can look at selling this 26 call and buying the 28 call. That gives us enough credit to justify the risk on the trade, at least a 30% return on our risk. If we were to analyze that trade, and let's put this on to the charts, and then let's make sure that this is lined up with that same date. You can see a high probability of success when I put that break even on the chart. And let's put it on the Bollinger Bands here. When I put that break even line onto the chart, you can see we essentially have to break up above through that volume area, through these old highs for us to start to lose, to get to that level, which as of right now would be a $40 loss today if we did, compared to a $48 gain. So I have a little bit more room beyond that level, up to about $27, before I lose what I'm willing to lose on this stock before I move on to another trade. So let's go ahead and put that on and take advantage of any potential weakness in discretionary and cyclical stocks during this intermediate pullback, but especially in the stock that's already having its own bearish patterns and with a potential technical support breakdown of a pretty significant support. All right, now that does it for me. You've heard from me. Now I want to hear from you. Let's keep this conversation going over the weekend. With any questions or comments you have for me about what we talked about in the video, or for that matter, anything that we didn't talk about in the video that kind of pertains to our discussion here, open a new thread in our forums. There's a link to our forums right there. Remember, you have to subscribe to our site to participate in those, but you can do that for free. So just open up any new thread with any questions or comments, reply to anybody else's thread, and let's just keep this discussion going, like I said. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video. Follow me on Twitter for more content in between videos. Join our community on Facebook as well as on marketscholars.com. Thanks again. Have a great weekend, and we'll see you all next time.